Hey everyone, and welcome back to another earnings review. In this case, dLocal. I know not a lot of people are following this company. That's completely fine. It's a company I own in my portfolio. It's one that I think will perform extremely well in the future. Small cap, I'd say, market cap of around $3 billion right now. For the quarter, a double beat. It's another Latin American play, more focused towards the emerging markets, especially when it comes to payments. Right now, after hours, the stock is up 15.5%. I've been talking about this company for quite a while, but it's nice to finally see the business go up as well as the stock. And don't forget that this is a fast growing business that is already profitable and I believe has little to no debt. And now, big announcement, they're not going to buy back more shares. No, they're actually going to pay a special dividend in I think a month from now. And starting 2026, they're going to pay a dividend. So this is becoming a dividend play. Believe it or not, super early in their journey, I was scratching my head. This was very strange because you know me, I love buybacks. I don't like dividends. Because dividends, I get hit by taxes, buybacks, not. Pretty simple. They did explain why, so I'll explain in this video. I'll go over the most important parts throughout the video as well. I'm pretty happy with the performance. The only reason why I kept holding this was because of Pedro Arnt, the CEO, which was previously the ex-CFO for Mercado Libre. And you know me, I love Mercado Libre, so anybody from there coming into another company that I own, pretty good, pretty small, high growth, profitable, becoming the CEO, well, a no-brainer for me. So let's go over all of that. If you enjoy this type of videos, hit the thumbs up button, subscribe if you have not, and if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, let's start off here with a couple of comments. While the short-term macroeconomic headwinds persist across emerging markets, we remain deeply confident in the strength of the secular growth trends shaping these regions. Nearly 90% of the global population under the age of 20 will reside in emerging markets by 2050. These regions are also projected to amount for approximately 65% of global economic growth by 2035. This youthful tech-native population is driving the rapid adoption of digital solutions, especially in areas like mobile payments, digital wallets, and embedded financial services. And of course, dLocal, if they execute correctly, they're going to be quite a big winner in those markets. Now, moving on to the dividend part of things. Our board of directors has approved both a dividend policy as well as the payment of an extraordinary cash dividend of approximately 52 cents per common share for a total cash outlay of $150 million. This decision reflects our commitment to returning value to our shareholders while maintaining a disciplined approach to capital allocation. More details about the announcement are available in exhibit blah blah blah. After careful consideration of our capital allocation strategy, we concluded that a dividend policy aligns with our long-term objectives. Our company expects to generate consistent cash flows over time, which will suffice to meet our strategic goals, including possible inorganic growth through targeted M&As, increases in capex when required, and investments in large business development deals. So basically what they're saying is, look, we believe our business will generate enough cash for us to pay a dividend and operate our business the way we like it. We might even do some M&As if we need it. They also will begin paying a regular dividend from 2026 onward, starting with a 30% free cash flow payout ratio. Now, here they explain the reasoning behind. In addition, when evaluating the most efficient way to return capital to investors, we, along with other advisors, determined that a dividend was the optimal choice given the current limited liquidity in our stock. A buyback program would have placed further liquidity constraint on our trading volumes, potentially impacting the stock's performance. Basically what they're saying is that the stock is not liquid enough, very, very low volume. By opting for a dividend, we ensure a direct and equitable return of capital to our shareholders while preserving the flexibility needed to execute our strategic initiatives effectively without placing additional strain on the daily liquidity of trading in dLocal shares. I would assume that maybe in the future buybacks will come back as there's more liquidity in the local shares. And plus right now, since this is going to become a dividend paying stock, it will attract dividend investors. So I guess they're that. To me, this doesn't change anything how I view this company. I would have loved buybacks, but okay, I'll take a dividend. Moving on to revenue by geography, we can see that Latin America makes up 75% of the share. That's up from 68% in 2024. Africa and Asia is now 25%, down from 32%. And if we look at Latin America, the biggest chunk is other LATAM, which are a couple of countries. Then we've got Mexico, Brazil, and Argentina. Argentina almost doubling in share, Brazil coming down. And this is basically what they're saying here as well when it comes to revenue or gross profits. Yes, sometimes one geography might be weak, but the weakness there will be picked up by strength elsewhere, which is exactly what we're seeing here, which is what we've seen previously with Egypt and Nigeria as well. Now, all in all, if we zoom out, this is the growth that we're getting. Non-Latin American revenue has increased at a compound annual growth rate of 76.2% since the March quarter of 2022. Of course, much smaller part than the Latin American revenue, but even that has grown at a compound annual growth rate of 28%. If we look at TPV or total payment volume, since the March quarter of 2022, that has grown at a compound annual growth rate of 56.7%. Looking at net revenue retention rate, we are seeing that it is recovering. We did bottom here at 100% June quarter of 2024, then 110, 106, and now we're at 113. They gave us 3 takeaways: consistent and strong execution, commercial efforts delivering tangible results, and tech investments driving efficiencies. And by the way, they're not done with the investments just yet. They're going to continue throughout 2025. But when it comes to margin, they expect to exit the year much better. And then starting 2026, I believe that's what they say, you're going to see, well, the core business, the efficient business, well, being portrayed in the margin expansion. And maybe in the midterm future, we might go back to the margin highs that we've known previously. But they didn't want to commit just yet since we are at the start of the year. Looking at gross profit by geography, Latin America is 70% of the share. That was down from 77% a year ago. 30% is Asia Africa, up from 23% a year ago. Looking at the growth and the decreases, Argentina is up 16% quarter over quarter and 106% year over year. Revenue growth in addition to increasing advancement volumes, which have higher take rates and higher FX spread driven by wider gap between official and parallel rates in Q1 of 2025 and Q4 of 2024. Egypt is up 2% quarter over quarter and 58% year over year. Lower quarter over quarter volume growth driven by seasonality in the advertising vertical. More on the advertising vertical in a bit. Mexico is down 1% quarter over quarter, but up 8% year over year. They say here decreased volumes from commerce players given seasonality and partial volume loss with a large merchant. Brazil here, of course, an important market for them now and in the future, but that's down 12% quarter over quarter and 27% year over year. Despite volume growth, gross profit was impacted by one-off incremental processing costs. And then other Asia and Africa, down 20% quarter over quarter, but up 121% year over year. Despite volume growth across various countries, gross profit was adversely affected by increased processing costs in Nigeria and South Africa. And so, if we look at TPV, that has increased 53% year over year. Revenue increased 18%. Gross profit is up 35% with gross profit margin up 5 percentage points. Adjusted EBITDA up 57% year over year with adjusted EBITDA margin increasing 7 percentage points. And profit is up 163% year over year with profit margin up 12 percentage points. So pretty good quarter, I'd say. Now, when it comes to net take rate, if we look at the quarter over quarter performance, we are down a bit and we're taking the biggest hit here. Weakness in key advertising merchant. They talk here about a mega cap merchant, a pretty big one globally. So they basically said, look, this one has a higher take rate. So when we see this one slow down doesn't mean that it's not growing, it's just slowing down. Then yeah, the mix shift is not in their favor. And that's why we're seeing this one basically take the biggest hit. But all in all, like they've said previously, they expect that the hit that they're taking on take rate will be made up with a volume. As for net income, quarter over quarter, very, very solid growth here. So solid net income growth quarter over quarter comparison explained by positive non-cash mark-to-market effect related to our Argentine bond investments and lower finance costs, which you're seeing right here. And this was up 163% year over year. So yeah, all in all, I mean, a very good quarter. Last quarter was already a good quarter. They were going in the right direction. Stock didn't react as expected. Okay, we've seen that previously with a lot of other stocks, but dLocal was a pretty volatile stock, especially in the last 12 months, maybe 18 months or so. Either the stock went up a lot after the quarter or it went down a lot, but there was a lot of investment. So when it came to gross profit margins, there were a couple of quarters where that was trending down. And then suddenly we had one quarter, I believe it was 2 or 3 quarters ago, gross profit was going up, but they were still investing quite a lot. So taking a margin hit, the market was still not convinced that, well, margins could pick up again, gross profit could continue to climb. And quarter after quarter, they were proving that, look, we know what we're doing. It's a capital light business. We are investing a lot right now for the future. We know what we're doing. And it does seem like finally the market does understand this business a little bit more right now. I mean, gross profit is up 35%, like I said, with gross profit margin now closing in on that 40%. So yeah, definitely a good quarter, good reaction. Of course, we're still far away from where I think this company could go. Execution here is definitely key. They know that they are still a small player, all things considered, right? A company worth $3 billion in a market that's worth multiple tens of billions of dollars, if not more. It's still early days, but yeah, I do trust management and I do think that this will become another multi-bagger in my portfolio in the future if executed correctly, of course. And so that's about it for me. Yes, it is another Latin American name. I have Mercado Libre. I have dLocal. I used to have New Holdings as well. Just put it all into Mercado Libre. So yeah, I like to diversify a little bit. Of course, I'm still very, very heavy United States. I still have Alibaba as well, believe it or not. I think they're reporting tomorrow before the market opens. So stay tuned for that. Like, subscribe, do all of that. And I'll see you all in the next one. Bye-bye.